want to say hi to all you guys. Say hi to everyone's on the call. So thank you for keep coming back. This is the call number 4, Zoom call number 4, and I've been doing this since the end of the middle of March, and trying to the 2 things is I want to do this consistently while everyone is at home. I want to give someone to look forward to every week, and to be honest, at the same time, I want to give something for myself to keep looking forward to, because I see Scott is smiling. It's true because I want to it's really easy to be sucked into the news, and while waiting, I just talk story. One time I was at the beginning of all this happenings, I was watching the news for strict 4 hours. At the end of this strict 4 hours, what I find is I was really stuffy, like on my chest, and then I didn't know what happened because at the beginning of this. And then what I actually found out, I think I have a little bit of depressions. So for all of you guys, just sharing some of the screens, some of the news, and don't take it too take it seriously, but don't indulge too much. So without further ado, I'm going to just kick into the call. Welcome everyone's joined the call, and feel free to say hi. Feel free to say type on the chat. I will get to all the questions at the end of it. And if you have questions, let me know. We're going to be talking quite a bit, pretty heavy subject. We're going to talk about underwriting today. For most of you guys know that, this is me. I'm an investor. My company Hate to Break. I started doing investing in 2006. I invested in Canada, in US, in China. And so I've been doing single family, multifamilies, and I've been sharing how people can invest and learn and from some of the great mentors of me, and I'm learning it and passing it on to other people to how to do investing in the multifamily space. And I have hosted different events. So this is some of my mentors and some of the propagation I've done over years. So why this Zoom call, by the way? Why this Zoom call is because it's 4 things. I've been saying it over and over again. For first, I want positivity. I want something to look forward to every week. Something, we have a lot of bad news, but I think a lot of people knowing this, we're in this for a long haul. So I want everyone to come out stronger after this situations. So that's number 1. I want all of us to be more prepared mentally, physically, maybe also financially, in terms of how do you take advantage of what is going on right now. I have an investor, long-time investors, actually banker for 30 years, and he has managed a lot of funds, maybe $1 million of fund. And he asked me this in WhatsApp. He asked me, so what do you think about all this REITs and commercial and industrial? And I paid a lot of attention what's happening. But the fact is, I have one screen to talk about how much we have decreased in terms of all the REITs, all the companies. I would like to share a little bit of that later on with all of you guys. What I think, where it's going to be. I think if all you guys know that if the price comes down, it must come up eventually. But I'm not gonna say that we're gonna see a lot of that right now immediately. But just gonna admit all of you guys here coming in. But really, number 3 is more opportunity. I think this is a perfect opportunity for all of you guys who are trying to be prepared right now. And the world is not coming to the end. And last but not least, I want you guys to start doing some of the things as what I've been doing right now is creating a deal flow, talking to the investors, and researching the market. And this is the perfect opportunity, because a lot of people, a lot of investors thinking, when's the end? Where's the end? The fact is, no one's know. Like I'm telling you, I don't know. Even the greatest mind doesn't know. So the only one thing that you can do right now is get prepared. And when the opportunity comes, you don't have to start learning, and you don't have to start creating a broker relationship. You don't have to do all those things because you already done it. I've been saying over and over again every week. I'm telling all you guys, you do it now. You don't do it 6 months whenever the opportunity comes, or 12 months later on, because that's the moment that you can learn and take advantage of it. If you're at home, you are unfortunate, like a lot of workers that is actually losing job or cut down on your hours. This is the perfect opportunity. I can say more than enough. So I tried to create some slides so that it's more interactive for you guys who are attending. So please say yes. Please say yes or type yes if you go through some of these times. So first of all is .com boom. Who have gone through that? You have seen this before. So feel free to just nod or like, say yes, and you've seen this before. The .com booms, like, when feel like everything coming to the end. I come through that. 1997, I was in high school. I was writing my public exam in Hong Kong. I still remember that. It feel like the world's coming to the end. Real estate properties go down significantly, and of course they go up significantly after. But again, type yes, or just say that, if you're in the part of the world, if you're Asian, if you come from Hong Kong, from China, from the Southeast Asia, you feel that. So I want you to type yes and think about what happened at that time. It feels like long time ago. I was only 17 years old, but I still remember it was a lot of fear. It was tons of fear. And September 11, I didn't want to put a picture of that. But again, big fear. I was in university. I see the screen, CNN reporting that at that time. And again, after that is a big correction. And last but not least, 2008 global financial crisis. A lot of us like is still in the back of our memory. We experience that. So I want all you guys to think about what happened during those times. Now I know it feels like it's long time ago. But the thing is, we go for all those. We go for the bubble, we go for the Asian crisis, we go for the SARS. I haven't even put it in here. In 2003 in Hong Kong, in Asia, in China, and in Canada, some part of Canada too. We go through 2008, and we have now today. So I think slowly, I was talking to another long-term investors who is really well respected in Calgary, and he tell me this. We are getting really tired of this separations. Daycare, no daycare at home, or whatnot. We really exhausted. And we really need to have to start. We started now. Some of you have already restarted, by the way. And I say that again and again and again because I want you to take advantage of this. Because when everyone jump into the market, when everyone thinks that, oh, this is a good time to buy, that would not be a good time to buy. It's right now, people are, kind of like, I don't know whether it's a good time to buy or not. That is the good time to buy. That's a good time to, I should say, that's a good time to invest in yourself, invest in your knowledge base, meaning to build the relationships with the people who are in the market, who have, that's tons of, maybe not tons, that's people who are trying to sell right now. They're going to decrease the price. And I already seen it already coming down. Single family, multifamily, across the board. You already see the correction in the stock market. You're going to see it in the real estate market. Why want this Zoom call? And we talk about this all the time, over and over again, because the first move opportunity, if it's not here already, I think is already reviewing. Why? Because I have been talking to my mortgage broker, to my real estate brokers, and to my property managers. I'm seeing my properties coming in, how many people delinquent coming in, and it's coming. If it's not to the worst yet, it is coming, and you need to be prepared. Today the agendas, three things, really simple. I want to talk about a little bit on the update on real estate. So I want to keep it like this. I think I kind of like after the 4 meetings with all you guys, I think this is kind of what I want to do. I want to update you guys on what is going on in real estate, a little bit of that after the whole week. I want to talk about one topic today. I picked underwriting, particularly. I think it's really timely because I want to talk about underwriting for what we're going to be seeing in the 6 months, in the 12 months. I don't want you to underwriting what's happening in the last 2 years, because that is not conservatively underwriting. You don't want to look at what's happening in the last T12. In fact, you want to project what's going to happen in the 6 months, 12 months, and that's going to protect you, or what we say underwriting for the recessions going into the future. And I want you to share about what is available resources from me or from other people who are able to teach you how to do investing in cash flow, investing in apartments. So this is what happened on the stocks in the first quarter. And you see this, we have energy goes down, we have all the stocks go down all the way to 80%. And real estate is in the middle of the pack. This slide is supposed to be moving a little bit. Let's see if I can get it moved. So let me know if you can see it. So this is beginning of February, and this is now. So it obviously decreased a lot. And that's why, hence, I got this from this 30 years old banker. And, you know, he tell me, so he asked me, is it the opportunity to get in right now? I already see people already taking some actions. I don't know, to be honest, but I think is if you don't take advantage of it, if you don't start doing research, if you don't educate yourself and thinking of the question is it a good time to buy? Because things is going to come back up. I'm going to show you another slide. Things is going to come back up. If you only react like, you know, like some of the people who buy only 2000, like late in the cycle, of course, it's going to be higher risk. So update on real estate and financial, I did the financial screens. On the rents, we see upwards of delinquency of 40%, month number one. On some of the properties I've seen, even on my properties, the delinquency go up. How do you mitigate that? You know, as an owner, that's not what you need to know. Like if you're already buying it, yes, that's you're dealing with fire right now. I see it, I feel it right now. I'm still on my ass right now. But I'm talking about people who are going in right now. So you need to buy in conservative. You need to buy in right. You know, delinquency is up 40% and up April. We talk about month number one. And I already seeing 20% discount, 20% discount on some of the motivation sellers. I was talking to another investors who we were going to go in at the beginning of March. Thanks God we didn't go in, and so we are actively looking because we know that a lot of investors will be freaking out. A lot of investors will be thinking of, you know, to sell, and if they need to sell and if they have to sell, whether that is for culture, whether that is they just need the cash or they just need to the 1031 whatnot, then the opportunity is for the people who are looking to educate right now and able to take pull the trigger. And this is the screens I want to share with you guys. I was looking at I think it's a chat on the statistic of the World Bank. I forgot where is that, but anyways, talking about this. So it showed you from 2000 all the way to 2008. Three countries, I just pick three countries: Canada, US, and China, because that's where I invest myself. But you see this, Canada is doing really, really well. I don't know whether it's going to keep doing well. But US were at 60%, it's an index here, and they put it in 2006 is 100% index. It's go all the way to 120 lately. So you see this screen, so I'm just moving a little bit here. You see the screens is, so China is going to keep going up, and we haven't have this is all backward data, by the way, guys. So this is not real-time data. So we know the last 2 months have changed tremendously a lot. But Canada and US, so yeah, so if you look at 2008, so it comes down quite a bit, but it comes down to 80% compared to 2008, and then it go back up. So what go down must come back up, and that's why I keep saying is, you have to really put things in perspective. If you're buying for long term, if you're buying a cash flow, I should say that again. You buy for cash flow, yeah, you buy for long term. But if you buy for cash flow right now, and you plan the cash flow for the next 2 years, meaning that you're offering, you come into the market that is reasonable enough to buffer for that, you're going to be fine. So this is the third time I'm showing the screens. We were at a little bit over 2 trillion at the beginning of that, and then we keep going up 5 trillion last 2 weeks ago, and then this is last week. So tomorrow again, Federal Reserve is going to every Thursday is going to release these. My guess is it's going to keep going up. My guess is going to keep supplying, keep supporting all the real estate market, all the commercial market. The question is, we don't know when does this end. We don't know. We're seeing some of the, people trying to project it end of May, beginning of June, but this is how I look at it. This is a fantastic opportunity. It doesn't matter how low it goes. If you haven't owned anything, this is always my position to all you guys, the 4th week now, if you haven't owned anything, if the price keep correcting, isn't it fantastic opportunity for you guys? That's my question to you. It's the best opportunity for you guys. If you're not holding anything, if you own small things, this is best opportunity for you, because it means that all the big guys has taken all of it, have taken 50, 60% plus hit. If you invest in risk, I don't personally recommend, but if you looking at that, those are already reflecting it. And real estate, private investment real estate is going to reflect that to a degree. And I don't know how much. Right now, if the market is already reflecting 20%, and your guess is as good as mine, it's going to keep going down. It's going to keep going down because that's not a many buyer. People are fearful. The people who want to go in and knowing that, it can cash flow. If they budget, I'm going to show you the free formula to get on budget. If you're going to budget your cash flow to be able to maintain that for the next 3 years, next 2 years, and you're going to be going okay. And that's the time that what I call the generational wealth maker. Because you go in right now, that's not enough buyers coming in, and when you're going in, you can lowball, you can really sink into the price. If they're asking $1 million, in fact, I'm hearing people keep getting a lot of lowballs offers. The seller's not going to be, you're not going to give right now, but if they want to sell, they need to sell. The time of the moment of opportunity is between now, is not even now. If the reason why I'm practicing lowball offers right now myself is because then in 6 months, in 12 months, the building is still here because the cash flows keep going down. And guess what? If they need to sell, they need to sell. And if you give them lowball offers in 6 months and they haven't sold, what do you think the price is going to be? It's going to keep going down. So, that's the update for the real estate market, and that's the update for what is going on the financial market. So my next steps, I always want to keep the component as in the update and what I'm telling you in terms of the value today, something new every week, and then how can you learn? So again, I say that on my meetups, I just put it on the Zoom right now. First, you need to research the market, and then you learn how to raise the capital. And you have to create your team on your market, negotiate. That's a really big thing right now. In fact, what I'm thinking of, like what I'm doing is like, I want you to think about how you're going to negotiate, how you're going to be getting the best offer in the 6 months and 12 months. It's really huge because the market is not doing this. The market is not doing this. The market is doing this. So you have to know when you're going in how much you're going to ask for, and you're going to be negotiate conservatively for yourself, but not for the seller. Remember, you don't have to buy. You don't have to buy, but you're buying it for the opportunity. And if the people who need to sell right now, they need to sell because for whatever reason, and they need to basically exit. And that's why this is a fantastic opportunity. And so underwriting. So today actually is about underwriting. I'm sharing with you the three formula that I'm sharing over and over again. The cash on cash, the debt, the DCR, the debt coverage ratio, and also the cap rate. So what are the appropriate numbers to going in? Well, but first of all, you have to understand how do you calculate it, and that's what I'm going to do because I see some people who are new coming in and want to learn about real estate. This is the best time, and that's why I'm doing this every week. And learn to lead is basically another term says you have to be creating your team. Whether you're going to find other investors invest with you, or you're going to be creating your own kind of your group, and you have to do it. And last but not least, you have to learn how to finance at this time. The last time I know is only one who's still doing financing right now First of all, one of my apartment buildings is actually up for refinance. I'll give you this story. It's really interesting. And I send this to the bank and say that, this is not the best time to refinance. I get it. And, the first thing he come back and say, you know what, we're not touching anything if it is not apartments. This is how scary is that right now out there. There's no insurance company, there's no CMBS, there's no nothing. It's the only one who's doing it. As far as I was educated from my mortgage broker and from the bank that I was trying to deal with, is they're only touching apartments. Hence, that's why we do apartments, right? They're not touching all these fancy buildings, because right now there's zero occupancy. They may be paying for now, they may still be paying for now, but you and I know if everyone working from home, and that's going to be a lot of M&A. That's going to be a lot of M&A. If you're following Airbnb, they just got $1 billion private fund just to keep them afloat. They think on this program, they just got to keep their afloat. I think the validations from 36 billions count down to 29 billions, and your guess is, they're going to keep going down. And people who have the capital right now, plus they're going to be ready right now, meaning that if you don't have capital, you're going to say, I don't have capital. But what are you going to do? You're going to start to collect capital. You can start to collect and talk to people. People like the difference is what I'm doing is right now, I'm still engaging to my investors, because I do know the smart investor right now, they know that the opportunity is going to come sooner or later. They don't know whether it's 6 months, 3 months, or 12 months. But if you still keep on the conversation going with your investors, with your private investors, you're going to give them confidence in 6 months, in 12 months. When the market is right, you're going to give them the confidence to, because you have been studying the market at the beginning of March, April, and I don't know, God knows when this is to the end. Well, to the end of this, I mean the cap of the case, but when the case is reached maximum, you're going to have the time, and I don't know whether it's like 3 months or 12 months for the real estate market to really sink in, meaning that the property that is not doing well, they cannot pay the debt service, and that's a lagging. That's what I'm trying to say. Typically, that's a 90 days lagging, but I think the price has already come down quite a bit, and I don't know this time the 90 days is true or not. But I'm already seeing the price come down 20%, and I'm pretty sure if you going given offers right now, you know what I'm talking about. What I'm telling you, you have to start doing those things. You have to start negotiating deals with the brokers. And negotiations and underwriting for cash flow, that's right now. Like if the deals, if the delinquency is at 40%, and if they are getting a million a year, so I'm talking about apartments and for the gross rental income. And right now, if they're only getting 40%, and I don't know, this is only a month, if they're getting for 3 months, and that's going to be 40% divided by 25, so it's going to be 10% delinquency, assuming that everyone's go back to job. And you see, whatever you see, I see too. Some people really, I say realistic. I was going to say pessimistic. A lot of people out of jobs. A lot of people not working long time in long enough hours. I see 30% on Q2 in terms of unemployment. I think that number is really conservative. If you look on the street, I was walking that downtown from my office to the parking lot. I was walking on the street. I probably only see 20 people walking on the street, and I was talking to my wife yesterday. I feel unsafe. And I say the reason why I feel unsafe is because I'm okay, but I'm talking about other people who like me walking downtown. You talk about 80% of the people who are walking still on the downtown, they're homeless. Like, they don't have home. The only people they're walking in downtown is only me going to the office and doing the Zoom call, or the people who actually live on the street. So it's really unsafe. You talk about massive unemployment. I wouldn't be surprised if the number is 50% for 3 months, for 6 months. And I don't know, like 30% is big enough. Last time we have even remotely close to this is we have 10% in GFC 2008. That's bad enough. And you're talking that, right now 3 times. If we talk about 6 million, right? 6 million unemployment. and this number is keep going up. And I don't know, like what I'm seeing is that's triggering of the current situations is going to keep getting worse. So three things: find lucrative deals, find investors, and manage your asset. And I'll be taking times to show you how you're doing it. But really, you want to underwrite the cash flow, underwrite for cash flow. If you want to underwrite, you really want to know how to come up with debt coverage ratio, the cap rate, and the cash on cash conservatively. So this comes to what I want to share. How do you cash? How do you, like, for people who have been learning, coming to the meetups and things like that? Tell me, like, show of hands. Some of you guys, or even put it on a chat group, who know how to do cash on cash. Raise your hand. Very good. Thank you, Scott. And who know how to do debt coverage ratios. Basically, it's the bank asking you to do it. You typically want 1.2. My guess is they probably want way higher now, right? And also the question is, which property can sustain 1.2 right now? And last, I'm going to talk about cap rate. The cap rate is going to be is going to go up. Like a lot of properties going to go up, and especially on the market that has overbuilt. You know, some of the market is more vulnerable. Some of the more expensive market is more vulnerable because they just have more room to increase the cap or decrease the price. Cash and cash means that. So that's the formula I'm giving to you. Is your net operating income minus debt service and divided by acquisition cost. So feel free to print screens and whatnot. I'm going to slow down quite a bit on my chat here. So NOI is basically income minus expense. You know, in the simplified terms. If you're getting incomes from your properties or your rent, including all your other income, or your other incomes and your laundry incomes and application fee and whatnot, all the income put it together, that's your total income. And then you minus all your expense, basically all your expense, meaning the property management, taxes, insurance, repair and maintenance, and payroll, all your expense, contract services, all your payroll, property management fee, and all that. That's your NOI, and that is the most watched line when we say NOI, net operating income. Every properties have that's the most important line, net operating income. Whether that is the only one single line. If you increase it. If you increase it for $1, that's going to give you $14 increase of your return of your equity. 14 times. I give you 14 times because some market is higher, some market is lower, some market is like 20 times, some market is 6 times. So the more expensive the market, the $1 increase of NOI is going to be magnified. It's going to closer to 20 times more because it's every dollar increase is much harder in those markets. But it's just meaning that because of the cap, basically, we're going to go into that. If the cap is lower, in New York, well, New York is a bad example right now. But if it's Toronto, the cap is 3 cap. Let's say that on the times that we haven't moved anything, the time doesn't move, right? So let's say it's 3 cap. So you just basically use your NOI divided by 3% or 0.03, which is 3%. So you do that. But in a nutshell, that's the time right now we want to conserve the NOI. You want to basically, what is happening right now is the income is decreasing because, you know, the expense doesn't decrease. The expense may increase in a nutshell. If you have higher collection, when you have to get people to go out, you know, to leave your apartment, the expense may increase because of you know, you have to spend more on the lawyers and whatnot. But the income definitely decrease because of delinquent. So delinquent is a part of the income. So again, if you're going to envision that the income minus the vacancy minus delinquents plus all the variable incomes is going to be your gross, your top dollar income, what we call the gross effective rents, basically before minusing all the expense. So, but that line is decreasing because of the delinquency. So I heard in my markets, you know, it's the rent is not delinquent yet. You know, in fact, I see a lot of landlords trying to do is basically they're trying to get people to still pay. You know, they may not be paying on the 1st, on the 5th, you know, where consider usually the time that is considered late, but now they're moving into the 17th to the 15th. Of course, everyone's is a really tough time. And, you know, a lot of the state is also stopping people from kicking tenants out. You know, we as a landlord, we watch this really closely, and sometimes really conservatively, really concerned. But we are seeing this moving from the 5th, we're closer to the end of the month, we're closer to the middle of the month. We're watching it every month. I'm pulling my delinquency report every day or every other day because we're having these conversations. We're having the conversation with the property managers who are seeing this on daily. How bad is that? You know, again, going back to the conversations, we've seen upward of 40% or 20%, you know. I also heard a lot of rates in Canada. They are not doing bad. You know, they still get a collection of 90%. But my question is, you know, are they really telling the true answer? You know, I know that we all have to protect our investment, but the truth is, are you telling the true answer? When 30% of the people who is not working, you know, they may have savings right now. They may be getting the government the paycheck, you know, but how soon did they come? A lot of people, when they don't, you know, if you are working in a restaurant, you're serving, you don't get the pay, you know, if you don't get the tips, you don't get the paycheck right now, you basically, you immediately go to your savings or you go into your credit card. So we are looking, we pay attention very hardly right now. So going back to the cash and cash, NOI minus is equal to income minus expense in the simplified terms, and acquisition cost is really just the total money outlay, and the debt service is your mortgage payment, but the debt service is annual. So it's going to be if your mortgage payment is $10,000 a month, and you can times it by 12. So everyone's if you have a calculator, I'm going to slow down a little bit. I want to give a little bit of reality for you guys. Really calculate. So I have this example right now, so that I can interact with all you guys. So NOI is 20,000, 200,000. Your debt service is 90K. Your down payment is 400,000, and closing cost 80,000. Acquisition fee 40,000. Feel free to ask me, raise your questions, raise your hand, and ask me right now. If you don't know what we're doing, I want to do exercise with all you guys. I want to do a cash for cash calculation with all you guys. So so start doing it, calculate that. I'm going to give you 30 seconds to do it while I'm interacting with other people on Facebook. Any questions on the Zoom? So what I want you to guys, so and anyone have the answer already? Show hands. Who has the answer? I have a prize. I forgot to say that. No one have an answer.
Howard.
Will.
This is Will. 27.5.
27.5?
Yeah.
Who have a different answer?
Scott got an answer of 21%.
Scott got an answer 21%. I also got 21%. This is the formula that I could be wrong too. I didn't use my spreadsheet. I do it late 3 a.m. this morning. But I got the same answer as Scott, 21%. Anyone got the 21% as well, or 27%? But this is basically, the formula that I share with you guys here. So just plug in the formula, right? The NOI is 110, right? Because 200,000 minus 90,000. And so your total money layout or outlay is really your down plus your closing, and I'm actually waiting for people to answer me some questions. The question that I'm missing some things, but acquisition fee, and then just add it all up, and that is your cash on cash. Do you know what I did wrong here, or like I shouldn't say what is acquisition fee? Anyone's know what is acquisition fees?
How much you pay yourself for putting the deal together?
Bingo. Yeah, bingo. That's it. That's how you. And that's how much you pay yourself, and you bring upfront with the investors. How much? You always want to be upfront, because you when you're doing the deals, you're going to make money as well. That's a lot of work that you're going in doing it, especially negotiating a good deal. But anyway, this is how I come up with the cash on cash. Is NOI divided by minus the debt service and then divide. It's basically total money coming in per year, right? Then if you talk about, look at the denominator. This is the denominator. Let me see if I can. This is the denominator. The top part, money minus the total money going out. So 21%. So I can see this, first of all, the NOI right now, if you, depending on what you're going to use, the seller is going to want you to use the NOI from last year if they're going to sell. You're going to need to protect yourself, and you're going to need to know the price. The price, if you can go down, if you can decrease the price, the down payment is going to go down as well, right? So, but at the end of the day, you need to understand. You need to understand what's the cash on cash your investors is want it to be. Like, what do they want? What's your investor wants? And you need to have that conversation with them. Remember, I say that about raising capital. You need to have the conversations with your investors in time like this, and maybe 12% is enough, maybe 15% is enough. But don't jump in the conclusion saying that every investor is different, and because every money is different. But I suggest you to conservatively underwriting it and really know the numbers. And now is the time that if you know what you're doing, then you're going to be really benefit in 6 months. Okay. So next is debt coverage ratios. So debt coverage ratio, it's DCR. It's really simple formula. It's basically as your NOI divided by the debt service. So NOI, we talked about already, is what really is your income minus expense. At the end of the day, that's your income minus expense before paying the loan. So let's say you have $5 coming in, the rent, and you spend on your expense $3. Now you have $2 that is going to be needing to pay the mortgage and your investor, right? Again, if you have $5 coming in and you pay $3 for your property expense, you have $2. That is still good to go around paying your investor and the debt service. And the debt service is as you pay the debt service before you pay the investors. So it's simple as that. NOI is the net income coming in, netting the expense, and the debt service is the annual debt service payment, the monthly mortgage payment times 12. So again, I want you guys to do quick calculations. If I have NOI 55,000 and the debt service is 40,000, what is the debt coverage ratio? And Scott, if you do this again, and you may get a prize correctly. Anyone? One, two. 1.375. Yes, that's what I get as well. Anyone get 1.375 as well? Okay, let me look at the chat. I think some of you guys replying. So perfect. Laurie got 1.075. Tony got 1.075. Thank you. Yeah, so that's what I got. So the question is it good? Is it good? That's more questions. That's harder question. Is it good? I'm pretty sure the bank want higher. I don't know how high is that. Typically they want 1.2. Typically the land is 1.2. So I tell you a little bit of why is 1.2, okay? So go back to the example. If you have, so go back to this example. If you have 55 NOI, which is basically your net expense, your net income, sorry, your net operating income, basically you have income minus all expense. Now you have this $55,000. And so if the higher the ratio, meaning that if it's a 1.375, it's decent, it's not the best. Usually want even higher. 1.4, 1.6 is even better. But the bank really want 1.2. Otherwise, they won't even look at the deal, right? For a lot of different reasons, because that's different kind of deal. But if the NOI drop, which before today, you're gonna say, why are they gonna drop? Now you understand why the NOI will drop, right? Because the things will happen. Things will happen. Rent may not collect it. So 55 becomes 45, let's say, easily, right? If you have 40% delinquencies, it becomes 35, right? So now you don't have enough income to pay the debt service. And that's why you don't want only $1 to $1 to debt service. Because if you want $1 to $1, meaning $1 of NOIs to $1 of the debt service, meaning that how are you gonna pay your investors? You can't pay your investors, it's really risky. So that's why typically they want 1.2 or higher. So it can drop, time like this. Maybe you have to be creative. Maybe you have to dig in your reserve. You have to dig in your lines. Talking to all this, big company, they all dig into the lines. They don't want they don't want to stop paying the interest to the investors, because if you stop paying the interest for the investors, that's going to create a lot of fear. They don't need to have even more fear. In fact, they need to know that you're doing the right thing to collect the rents, right? In fact, they need to know that you're doing what's necessary, whether it's that has in place a reserve and whatnot to be ready this, and that's a good syndicator, that's a good multifamily investor should do. But if you have a high NOI to debt service ratio, AKA DCR, debt coverage ratio, meaning how much you have money to cover the debt, right? So you're going to be survive time like this. So you're going to be, how do you, if you have the deal, the question is, if you have the deal, how do you increase the debt coverage ratio so that bank will be favorable? So you look at the formula, just going back to the formula. So first of all, you're either going to have higher the net operating income, meaning more rents, or lower the debt service. So higher the rent income, obviously, in time like this, is going to be really challenging. You don't only do it in a good market or in a stable market. No one talk about how do you increase NOI right now. People talk about how do you stabilize your NOI right now. So the only thing, come back to conservative underwriting or conservatively negotiating, offering, is how do you decrease the debt service. You're either going to be, increase your total money layout, meaning that you have less debt, right? I'm not showing it here. So let me know if you're not following. Or you're going to decrease the price. When you decrease your price, you're going to decrease the debt service, right? Or you're going to be, again, increase your capital or your equity, meaning that you're going to have less, return, because the more money outlay is going to have less return. So that's come down to playing around with your price, offering price or purchase price. If you're buying in 6 months, if you're buying in 12 months, that's how you decrease the debt service. If you decrease the debt service, the DCR go up. Make sense, everyone? Does it make sense? Okay. Yes. Good. So so that's why everyone is watching how much well, I guess it's like come down to the how much can you come down the price, because the price has been just going up for the last 5 years, and also how long do you wait, right? Do you wait? Do you go in now, which I strongly strongly not recommended unless you got a really, really good deal, which can be possible, or you're going in when things settle down quite a bit, when you know slowly things going back up, when you know the border is opening. You know, we're still going up in this case. You know, the case of numbers and then unemployment is still coming up. It means the price is going to be, if the price of the properties is going kind of like, you know, the opposite direction, is going to keep going down for another 3 to 6 months before you're going to settle. So 1.375. Cap rate. Anyone's know what's cap rate, and anyone's want to participate? What is a cap rate in good market, bad market right now? Let me know and put it in the chat. And cap rate is basically just an NOI divided by the price, and you can see that, you know, NOI we described already, price is the one that we are looking at right now. So right now is this, you know, if the NOI decrease, which is what's happening right now, and the price doesn't move. Let's say the NOI decrease. When you decrease the price, when you decrease the NOI, whatever that is, the price usually need to decrease to maintain the cap rate, same cap rate. We look at the same formula. We just talk about 8 to 10 cap. That's a really good one. You really want to buy in at high cap rate. You know, 8 to 10 cap is good cap. You know, going in to buy it so you can cash flow. And my experience, if you're doing a momentum deal, if you have anything lower than 6 cap, it's going to be really tough to cash flow. I'm not saying that it's impossible. Every deal is different, but it's going to be really tough to cash flow. If you're not doing value add, if you're not talking about substantial increase of income in the year 2, year 1, which is really challenging. Obviously, right now we're talking about. And so cap rate again is NOI divided by price. You know, what we'll be seeing is a lot of owner, seller, they are in this moment, is like, you know, they keep holding the price. They're going to keep looking, you know what, and my price should be, you know, they either keep going in last year, the price has been increased a lot, which they cannot decrease it, not until they have to, or they just haven't sink in yet, right? They haven't sink in yet. But if this keep going on, the price has to come down. The REITs already come down. Like I was looking at the REITs, office REITs and things like that. The slide that I show you, it was from Bloomberg, and there's already some of the REITs go down 80%. So if you tell me the real estate market is not going to come down, you know, you're living in a bubble. You know, you're living in a bubble anyway here. So the price is going to come down. The price is how much can you go down? How much can it go down? My broker's telling me, because I was sure to get deal. My broker telling me is like, you know, he's putting a pause. You know, the seller is putting on pause 60 days. They don't want to sell it. They don't want to do anything. They want to assess it. They don't want to see any lowball offers. But your guess is my guess. You know, this is gonna come down. How much is it coming down? We try to find that. We're trying to find the equilibrium, and then seller's happy, the buyer's happy. The seller's never happy this time. You know, is really happy to be a buyer. Another calculations. NOI. If NOI is the cap rate is NOI divided per price. Price is 350,000. NOI is 35K. What is the cap rate? Pretty easy. 10. Scott, thank you. There you go. 10 cap. 10. Everyone's real Tony's cap. 10. Yes. So it's 10. It's like it's actually, so it's not the price divided by the NOI is 10. It's actually the 35,000 divided by 350, which equals to 0.01, and you have to times it. 0.01 is in the percentage or is in the decimal. So basically times 100. That's how all these guys get 10 cap. If you're wondering where does it come from, it's definitely not the 300. It's definitely not the price divided by NOI. I'm just looking at this right now. So yeah, 10 cap. 10 cap is pretty decent, and you can get something like this. I think is good deal that you can cash flow. But you still have to answer questions. Can the NOI keep going down, right? This really comes down to, can the NOI keep going down? And if keep going down, how much you have the budget, right? What if the market, what if you have to answer all these what if questions while we are projecting 6 months down the road, 12 months down the road, and how long this is gonna last, right? And no one's have the real answer, but the more conservative you can be going in, remember, you don't have to buy. You're gonna go in and buy the deals that the seller need to sell. And if the seller doesn't need to sell, and it's almost guaranteed that right now it's not the best time to buy that deal. And that's gonna be a lot of deals out there that's gonna need that. So really simple. I don't want like this is like a weekly call that I want to kind of basically every week I want to give you a little bit of nuggets. Basically, we cover cash on cash, that cover ratio and cap rate. What is actually good in time like this? The fact is your guess is as good as I. But we know that the cash on cash is going to decrease, right? If you don't decrease the price, right? In time like this, the debt coverage ratio, if you don't decrease the price, is going to go lower. The lower upon that, the bank is not going to lower. It's not going to give you the loan, or you're going to go on in with cash, and then that's different questions. But it's the fact is, if the NOI decrease, you probably want to decrease the price, at least in your offering, so that you're going to be it's going to increase the debt coverage ratio, which meaning that your lender is going to be more comfortable lending your money, and the market is moving very quickly, and that's why you have to pay attention. You can't pay attention 6 months from now saying that that's maybe good. You have to have kind of like a spectrum of time that you're looking now. If we're talking investor, you're talking now, March, April, May, and keep looking, and then maybe in the summer you kind of have an idea. You kind of come to your own conclusion on your market, and that's how you build trust, and that's how you build a relationship with the brokers, with the investors. The last part, I say that, the first part I want to talk about the real estate market, what is going on last week, and we talked about that, and I shared with you the 3 things you have to be really look at right now, and that's the discussion point if you're raising capital. What is the debt coverage ratio? What is the cap rate? What is cash on cash? Your investor. And the last thing is, if you need to learn, I have something that you can learn every week, and in fact, I have something that on this Saturday, and come to the online event. We're going to talk about raising capital. And we talk about raising capital on this Saturday at 1 p.m. and MST time. And click on the link and let me know. Put on the Zoom chat if you need the link. I'm going to put it on the chat so that you can register it on this Saturday. And then next week we have the Zoom call again at 11 a.m. On Zoom call. And underwriting next Saturday. So I have this. Some of you, this is new. Some of you know that's already doing the boot camp. But I decided that I have underwriting boot camp for physical people who to join and pay and keep delaying it. I'm still doing that one, but for the people who register with me, I'm also doing this so that you guys don't have to wait forever. So I'm doing this 3 hours, and it's going to be on Zoom as well. It's going to be underwriting, just so that we can basically sing in on how do you underwriting for time like this. For time like this, for people who doesn't know, this is going to be available for other people who can learn how to do this. Because you need to, as I said, you need to learn what is the investor acceptable return, what is the bank acceptable DCR time like this, and what's coverage you need to tell the brokers right now. That's a conversation you have to learn. You have to do it right now, so that in 6 months, 12 months, you're gonna get the deals. And my market dominations. So this is further pushback, but I have market visit later on. You can't even leave the border, but I'm putting it there because I intend to do this later on. But that's it. That's it for today. So I want to wrap it up. For people who want to have questions, let me know. I'm going to leave it to the floor. Anyone have questions, ask me right now. You guys all good?
Hello, Howard. This is Will.
Hey,
yeah, I had a question earlier, and let me just pull it up real quick.
Oh, sorry, I missed it.
Yeah, when you were talking about underwriting, we're underwriting these deals a little bit differently based on the current environment. So are you talking about the exit strategy, and what kind of numbers would we be looking at? Like, I know you were talking about the NOI decreasing. And based on a trend, do we just tease that out and just kind of get an idea of what we should be offering based on what the trend's saying the new NOIs are going to be?
So the thing is, one thing that I would, so I would definitely underwrite, like, this is only month number one. Like we so used to be underwriting before today. We're so used to be underwriting with the deals that doesn't work, but we're going to be putting value add, meaning the increase the rent. We so used to be before that. So one thing that I wouldn't be doing at this time is I wouldn't be, in fact, all the value add deal is becoming a problem. Like what I mean by that value add deal is like for all of you guys doesn't know is if you're going in as a 6 cap and trying to make it as a 9 cap, it's really risky right now. I know a lot of banks is not doing that deals, doing value add. They're really I listen to lenders. But first of all, a lot of funding have to dry up except multifamilies. They still do multifamily deals because the government has a directive to doing it. Through Freddie Mac and Fannie Mae, to say they're still doing it. But I wouldn't be underwriting it that the income can go in and go up $150, $100. I would be really conservative, to be able to do that. Because everyone is talking about decreasing on NOI. When you're talking about jobs, how do you increase the rent? So that's number one. And I also will budget. When I put in the initial capital, I would also, if I'm buying, I would also budget 3 months, 6 months. That is going to be the NOI decrease. Like let's say if you have to buy in that deal, the NOI is 70% of where it used to be, let's say. So let's say if that is the case, you also have to budget the buffer for how long, whether it's 6 months or 12 months, and depending on the market, right? So I would be really conservative putting that buffer and basically have the money ready for the time. Like in fact, you should probably put in at least 9 months to 12 months, so that you have the money to pay the debt service, because remember, if you're 70%, you probably break even. We're not able to pay the investors, right? Some of the depend on the deals. Like every deal is different, but I would be making sure you either have the money up front, raising for the investor, or your own capital. If you really want to go in, if you want to jump in the good deal, great deal, or even negotiate the deals like much lower price, that, or even from whether in the form of repair, maintenance, or reserve or cash back from the seller. So I would do all sort of this. I would decrease the price. I would negotiate some fund cash back from the seller, so that you can keep yourself afloat for the next 6 to 12 months.
Okay.
And, yeah. And
so you're saying do a discount. So run the calculations like you normally run them, but discount for 30%, and then maybe for 12 months out, and then go back to the regular calculation. Okay.
Yeah. And because when you do an exit strategy, that's depending on your investor, and that depending on whether you can refinance it at the end of the day, right? So and that's also right now the time is you don't want to be doing 80% or 75% LTV as well. And I don't know what's Fannie Mac, or like what are they allowing right now. My guess is they're not doing 20%, 25% anymore. So you have to be on your underwriting. You cannot put 20% LTV. You probably do probably be wise to do 40%. LTV, like loan to values, like 60% LTV, basically 40% on your investor dough going in right now, because that is the time. Like if you drop another 20%, then you need to be conservative. You need to be conservative. That's the time right now. You're going in and you're going to be thinking, hold on at least 3-4 years, and with that you need to be able to buffer it right now, because it's a really risky time, right?
Yeah. So you're saying you need to have. Well, I don't have any existing deals, but that's where you would have a conversation with your investors if you had deals already in place, and you just explain, you already had this conversation with them beforehand, before they bought, so they know that in times like these, you would go to plan B as far as holding on to the property until the conditions change.
Yeah.
And then, one other thing, and just to clarify what you just said, we'll be going by the guidelines from, these places like Fannie Mae, Freddie Mac, as far as LTV, right?
Yeah, and I don't know what's the latest guidelines, because it changes fairly quickly. But my guess is I would, the deal need to work at 35 to 60 to 40%, or 65 to 65 to 60%. It needs to be worked right now, to be able to be conservative underwriting it.
Okay, thank you.
Yeah. So yeah, Scott, to answer your question, yes, at least the lender that I touch with, yes, the lenders are only touching the deals from apartments. Yes, so they're not touching, and I kind of know that, but I don't know that, because because basically there's the questions. I was talking to lenders, like, I have a deal that I want to refinance, and that's the first thing he said, like, I'm not touching any deals other than apartments. That's basically immediately. So let's speak of the risk, right? Let's speak of the risk that for the people who owning commercial in the sense of retail, office, and hotel. The hotel is the biggest one, because it's always opportunity, right? There's always opportunity when time like this. But again, you have to educate yourself. And I always say this, that's the reason. There's always a reason why they still do apartments. For first, the government supported it. For second, they know that people need to live, right? Then that's why I trust apartment myself. But I mean, yeah, it's really tough time for people who owning hotel right now. They see the occupancy rate drop. It's not for me. It's a report that I look at the late last month, mid last month, March. Hotel from 70% to single digit occupancy. If you're talking about apartments, 30% delinquency, 40% delinquency, is already much better comparing to, because you don't have to go to the hotel. That's the thing. You don't have to. Airbnb. I saw news yesterday. Someone sent it to me. 80% decrease of new listing or refund of money for Airbnb. 80% decrease of revenue. That's a lot. 80%. You talk about 20% is probably it's probably affecting your bottom line in terms of making profit. You have to be losing money, like on all this owners. So that's why when you pay attention to now, why I'm encouraging people to pay attention to now, because if you pay attention to now, in 3 months, 6 months, you have a snapshot of. You're basically doing your balance sheets, right? In the global economy. You see it right now, or a month ago, you see it right now, you keep looking at that, is it keep going down, improving? And because you think looking at a chart is the same. It's not the same. Because if you're not in the market, you don't know what is it like. That you didn't have the conversations. But if you have the conversation now, yesterday, and before, and then 3 months from now, 6 months from now, and that gives you that wealth of knowledge that you need, and your investor will need to be able to make that decisions when you need to make that decision. Let's see 2 more questions. Tony, underwriting boot camps. So underwriting boot camps for the 3 hours is $200. I'm going to send it to you. I'm going to put it here so that you guys can look at that. For the people who already registered for a physical boot camp, they're free, because it's just for Scott, for other people who are registered for it, is a value that I want to intend to give it, because they cannot. There's no physical one. So for the people who are already coming in, there's 5 or 6 girls that you guys should come in, because it is. I'm not charging. Of course, I'm not charging for you guys. Just going to copy the link. So yes, you guys should come in. on top of what I'm going to do for the physical one, just so that you guys can learn beforehand. Physical. There you go. So I'm copying the link. So for you guys, let me know if you guys want to join the underwriting bootcamp. And so Laurie, you asked about Canadian banks or US bank. I'm talking about US banks. I don't do much business with Canadian banks.
Hey, Howard, I have a question for you.
Yeah, Scott.
You were saying that value add is too risky right now. So how do you build that into your plan? Do you still build that into the plan and say, okay, we're gonna do value add, but it's gonna be a deferred value add for 12 months, 24 months, 18, whatever. Is that how you're kind of doing it? Or are you just saying anything that needs value add, I'm just staying away from totally?
I would still look at that. It depends on, like, I would not look at, for example, I would not looking at the value add that's only give $50. Like, that's a lot of that, like, before going in this recession, by the way, that's a lot of that. And they tell you $50 is value add. I always laugh at that. A true value add, it should be at least $100, $150. Like, that's my opinion, to have enough loans. But I do see a lot of that before the recessions, $50. The challenge with value adds right now is actually the lenders they're not, so this is the exact term. They're saying that I'm not too interested. They're not showing a lot of interest. This is what they say, the lenders, to value add deals. So they haven't said already that we're not doing it. So I guess if you can find a deal that's like, increase $100,000, yes, this is going to be really good. But I would be also really surprised unless you find deals that is like a whole long term that hasn't increased the rent. I think the best value add is right now is the one that is they do all the work, they haven't increased the rent, right? The meaning that you don't need to go in and do the renovations. They just strictly we call it the occupancy play, or we strictly management play, because the management haven't increased the rent. So I think those will still be I would still be looking at, but I would be really hesitant to look at anything that I need to put in $5,000 to increase $100 on rent. The fact is, it's going to screw up your, first of all, you need any kind of movement of tenants right now. This is going to increase your vacancy, and that's no at this time right now. You don't need it for the next 3 months, definitely. But if you are saying that you can, if the broker is telling you that you can find the deals, they can increase the rent, and without much moving on the tenants. But you have to think about that. If you find those deals, are you able to increase the rent right now? The chances you probably cannot do much anyway. The chances you want to stabilize that building, maybe you can budget that. You can wait for a year to increase the rent if your occupancy is so high. But everyone is dealing with delinquency, and when you talk about 30% unemployment, your guess is the people that every building is going to be affected to various degree. Some people will be affected more highly. Some buildings will be affected less affected. But I'm going to also be cautious. So for you guys, some seller maybe they're not honest right now. Some seller, they may be not honest. They may be telling you that this is still good, but that this is going to be. And I'm also not trying to tell you everyone is bad. I'm just trying to tell you, if 30% people who is not working, the fact is some people, even they stay in there, they're going to have hard time in the financials. They may be late on the rent. They may be late in the rent. They may be negotiating with existing owner. They can pay the rent lately. It happens to my properties, right? And to a degree, they may be less affected, but they're going to be affected. So if I'm seeing deals that it's come down to be honest, it's come down to, I would be really hesitant to value add. I would be really coming down to the sellers. If you need to sell, let's talk about the price. The fact is, if no one's need to sell, if they don't, no one's going to sell if they don't need the money. If they don't need to really have the need to sell. So we really have to come down to the discussion, because if you go into the seller and if you're not going to get a lot of price decrease, the fact is the chances your lender is going to have that conversation with you anyway. So you better going to have the conversations beforehand so that you have the credibility when you talk to the lender, right? So I think it's a really tough time. It's going to be a challenging time for people who need to sell. Even though I still see brokers sending out emails, some brokers still sending out emails, we just close this and whatnot. But you really need to have like honest discussions. The time has changed. The world has stopped it literally, and that's millions of people literally don't have jobs. If they have jobs, they're going to be affected by the decrease of pay. So we really have to be be careful.
So if you look at a property and there's you see potential for a value add opportunity down the road, are you just kind of staying away from that, or are you still?
I would be if I'm not getting a lot of decrease of price, I would stay away from that. Yeah, because the fact is, first of all, I don't need to buy. And if I'm going to be doing value add, meaning I'm flowing 300K or whatever into the renovations of that, am I going to get back to increase the rent? Like, can I increase the rent? The probability, the chances I probably cannot increase the rent. The moment you can increase the rent, the question is you're going to get in even higher vacancy, which is you can't afford it. You can only do that when the market is really good, meaning your tenants can pay. I would be really be careful. I would stay away with most of them if it is not very good deal.
Okay, so what about if it's a good deal, the cash flow is great, but there is an opportunity to do value add in
I would not underwrite the
24 months.
I would not be underwriting the value add component as to come up with my. I would basically do two calculations. First, with the value add, but I'm not talking about now. I'm talking about 6 months, a year. Start doing that. Second is the without the value add. I think that without the value part for the same deal I'm talking about need to be 8-9 cap, right? And with the buffer of the NOI that we talk about will, and need to be cash on cash need to be stabilized, like with that decrease of NOI. So because again, like this is a time to get good deals, and as we just the patience and wait for the deals, but do the work right now.
Hey Howard.
Hey Will.
Didn't you say we should be shopping now? So even though we don't pull the trigger, we're still going to be looking at the deals, and you're going to be running numbers anyway. So in Scott's case, wouldn't he just put that on his spreadsheet for follow-up?
Yeah, I would. Well, okay. So when it was, absolutely agree. So when I say to start doing, like keep doing the work, I don't mean to stop looking at deals, right? Because if you stop looking at deal, if you stop underwriting, 6 months down the road, you don't have the comparison, how low it can be. Like you don't have the reference point. All I'm saying is like you still, because why I'm telling you guys to still underwriting, keep on building relationships. Because most people will stop right now. In fact, most people will be immobilized and with the fear of, how low can this go? Well, if you're not owning right now, why do we have to fearful? We're not buying at this time. We're only buying the deal that's very, very good. So, but yeah, keep underwriting. You're right. Like, yeah, don't. So if I give you impressions that, don't stop doing things until 6 months. No, I'm not saying that. I'm saying that, keep getting deal flow, because, while many people stop doing the deal flow right now, you keep on building the deal flow. the broker is going to be happy to talk to you. They have all the time, and if you're educating them, you know, I'm actively looking, but also you and the brokers is not crazy. You know, you so the relationship building right now, when you look at 6 months down the road, you already talked to the broker 5-6 times. You're getting the flow underwriting. You've been another key thing is you're giving a feedback to the brokers, because if you get a deal and you don't tell the brokers what is a good deal, bad deal, the brokers cannot help you, and it's really hard for them to help you. Brokers only get paid if they close the deal, so they may even tell you, give me an offer, you know, and one good way to give an offer without being rude or without being overly aggressive is this, you know, and I say this all the time, and broker will usually appreciate, you know, because, you know, it's this. You tell the brokers, you know, I look at these deals, and you know the market is really unstable. I'm sure you understand. You know, no one's know where this rent is going to. I have the numbers, but I don't want to waste your time. If you still want to see my numbers, meaning that you tell them that it's low, right? If you still want to see my numbers, I can put a LOI to you. But if not, then you know what? I'm just keep doing my underwriting. That's the easiest way. Like, they're gonna ask you, 9 times out of 10, they're gonna tell you, so what's your number, right? So this is the best way without saying that, you know, I'm gonna give you 60% of the price, and at the same time that I'm gonna give it to you right now. So the broker usually appreciate that, you know, because you're saying that, you know, my offer is really low, but if you don't think that it makes sense, then tell me. I'm just not gonna waste your time. But 9 times out of 10, the broker is gonna say, tell me the numbers, and you know what? If you tell them, if you initiate the process 3 months down the road, the seller may come back. Maybe that's the only offers on the table.
Yep.
So yeah. So let me say that U.S. and Canadian banks for lending funds for the projects you have been referring to, Howard, need to offer. Okay. Yeah. So I don't know how Canadian banks is doing. I just know this is a U.S. bank, so so that's I know. But let me see. So after the question is, so next week, again, same time, we're going to talk about raising capital, and thank you very much for coming, and I hope you guys are happy hunting for the deals, and keep on building relationships. Keep on doing it, because it's just going to getting better and better, right?
Yes, sir. Thank you. Thank you, Howard.
Thanks a lot, Howard.
Thanks, Scott. Ciao. Have a good one, guys.
Take care. Take care, everybody.
Take care.